Hello, and thank you for joining us today for our latest Finovate webinar, How to Close the Trust Gap in Retail Banking, Why Customer Experience is Important and How It Must Change. I'm David Penn, Research Analyst with Finovate. Today we have Bob Meara, Senior Analyst with Celent, and Andrew Stevens, Product Marketing Manager with Quadient. In this webinar, we will define the trust gap in retail banking and illustrate its root causes. We'll discuss how leading banks are closing the trust gap through redefining the in-person and digital customer experience. We'll talk about how banks must retool to deliver excellent customer experience as engagement becomes increasingly digital. And we'll discuss practical next steps to take in improving your customers' trust in your organization, regardless of where you are in your transformational journey. And just as a reminder before we get started, this is an interactive presentation, so if you have any questions, feel free to send them to us using the Ask a Question option there at the bottom of your screen. I'm very much looking to this conversation with Bob and Andrew. I hope you are too. So with that, let's go ahead and get started. Bob, Andrew, the floor is yours.
Terrific. Thanks very much. And that was actually quite a very comprehensive review. Thank you for that. So first, as mentioned, we're going to define this thing called a trust gap. It's not nearly as popular of a conversation as customer experience. And then we'll look at ways that we think it can be closed. And then thirdly, we'll get less theoretical and much more tangible by illustrating some examples of how we think banks across the globe are in the process of closing that trust gap. But first, the research that spawned these slides didn't start with exploring the topic of trust, but we think it's an important topic. And the research came out of an ambition really to help banks exploring a future platform business model, but we think grew to have broad applicability, at least we think so. Now, of course, no single survey or report is the last word on a topic, and this is certainly no exception here. We don't assert to be trust experts by any means, but my hope, though, is that today's discussion would be compelling to you and might give you a framework to advance your thinking around how customer experience might need to change. So first, the trust gap. Celent surveyed U.S. banked adults twice in 2018 with the objective of understanding how and when in-person engagement was important, and we found some interesting things in the data we didn't expect. The good news is that since the financial crisis, consumer trust in banks has been on the rise globally, and we think this research, which is U.S.-centric, right, appears to bear that out. On the other hand, looking at these numbers, it could be unsettling that just 86% of surveyed adults feel their money is safe, and that fewer consumers would say kind of generally, I trust my bank. But there's a larger problem, and that problem, which we term the trust gap, becomes evident when consumers are asked about the level of trust they have in their bank when seeking financial advice, or their bank's ability to actually help them solve financial problems. And those are shown here. So knowing that one's deposited funds are insured and safe is one thing. Understanding that money moves as directed and isn't suddenly lost in one's account is certainly an important aspect of a banking relationship. And indeed, it would have to be reasonably sound for a customer to tolerate a bank relationship. But it's another thing to instinctively go to your bank for financial advice. We call this advisory trust, and it's the domain of a marked trust gap among U.S. financial institutions. So we think of it this way. Said simply, banks have done a very good job safeguarding money and facilitating transactions, but many have failed to convince at least most of their customers that they can actually improve their financial lives. In the same survey referenced before, a small majority, 55% shown here, were confident that their banker could quickly solve financial problems should it arise. Fewer, 39%, would seek financial advice from their bank when faced with a major life event, and just barely a third would seek investment advice from their bank. Worse still, less than half of surveyed adults feel their bank even knows them. Now, you might say this would be excusable for a brand new bank-client relationship, but 2/3 of the surveyed adults in these surveys have had a relationship with their primary bank for over 10 years. So this slide demonstrates what we're calling the trust gap. And that is the gap between transactional and advisory trust. And we get these numbers by simply averaging the results among transactional and advisory trust elements shown on the previous slides. And by the way, this is showing the result of all survey responses. The trust gap shown here, 42%, gets larger among higher income customers, and it gets larger among customers of the larger banks. So to us, the opportunity is clear. Banks need to help customers form good financial habits and build trust in their primary bank as not just a safe place to store funds or borrow money, but as a credible source of financial insight and tools to improve their financial well-being. And you say, well, of course, Bob, that's motherhood and apple pie. Who could disagree with that sentiment? Okay, I get that, but there's at least one problem getting in the way, and it's rooted in how banks earn revenue. See, most banks make money even when their customers don't have healthy financial lives, and that's at least part of the problem. So what causes this trust gap? This slide isn't meant to be exhaustive, right? But just a few of the more obvious observations. And when finished, we'll speak about the idea of trust being tentative or tenuous because customers, just as in other relationships, can begin to take the relationship for granted. So first, we think most banks articulate a narrow value proposition. It's mostly centered around products, and so competition is based on things like rate and convenience attributes. And importantly, customers have to figure out they have a problem, go to their bank and articulate it, and then hopefully be successful getting their problem or solved or their need met if the banker is understanding and responsive. We think banks could be much more proactive. Secondly, frankly, many banks behave in trust-eroding ways. Relatively minor customer missteps, for example, result often in punitive fees. And that was the business model disconnect I referred to earlier. And worse, fees are imposed coldly and with no apparent empathy at many banks, and typically they offer no help to avoid reoccurrence, right? Said another way, banks enjoy serial overdraft customers, for example, or those who frequently pay loan or card balances late. But see, the problem with that, it may earn current quarter non-interest income for the bank, but to customers, these banks appear to be operating in their own self-interest, not in the customers, and that is massively trust eroding. And then thirdly, many banks fail to deliver a compelling value proposition consistently, particularly if their value proposition is based on a relatively handful of traditional bank products and services, because after all, customers don't need a loan or a new DDA frequently. And so the ability for banks to reinforce the value proposition has eroded over time, and especially now as customers interact with their bankers less frequently in person and more frequently digitally, the ability for banks to really delight customers has diminished in frequency. It's not very often that they're able to reinforce their value proposition. And without that reinforcement, just like a marriage relationship, for example, it can go stale. And even the most delightful of relationships can become or can be taken for granted over time. We encourage instead banks to invite a new way of thinking, one that is decidedly win-win. And there's a couple of aspects to that. First, most banks' engagement models are inherently reactive. Customers need to come to them and describe to the bank what they want if the financial literacy scores are to be believed, most bank customers aren't in a good position to know what they want or need. And secondly, the discussion is almost always product-focused. As we mentioned, there aren't very many opportunities when new products or services are needed. And then thirdly, the trend toward deployment of next best offer analytics, while laudable and arguably effective in terms of sales building initiatives, if they're fixated on selling rather than finding the next best action to improve customers' lives, those initiatives aren't going to be trust building. They might be revenue building in the short term, but not trust building. So we think banks need to shift to a decidedly win-win engagement mindset. And in so doing, we think that the entire value proposition, how they establish value, deliver it, and how customers perceive it will change. And if it's reinforced, then that perceived value will grow over time, generating a virtuous circle. And this needs to be done increasingly digitally. Why? Because that's how customers increasingly wish to engage, not only with their banks, but with virtually every other retailer on the planet and with friends and family alike. The difficult news with digital is it's harder to engage customers digitally. It's far easier, by comparison, to transact in convenient and low-friction ways. That is indeed the purpose for which most banks invested in digital assets. If we spoke to most bankers, especially a few years ago, about, okay, what's the business case for digital? Why are you investing in digital? And beyond commentary around, oh, we need to do that to be competitive, the strategic intent for digital investments at most banks historically has been simply to migrate transactions to low-cost self-service vehicles, thereby dramatically reducing the cost to serve. And that's all wonderful, but that doesn't build trust, that doesn't build engagement, because transactions and engagement are two very different things, and they're perceived very differently by consumers. So, for example, transactions are a bit like a fast food drive-through experience, where speed and efficiency defines, and convenience defines the experience, right? Not the environment, not the aroma, right? Not the ambiance. All those things are right brain versus left brain. They're not about speed and efficiency. They're about trust and value. And that is the realm, the very right brain realm of engagement. And that's inherently difficult to do digitally. Moreover, most banks haven't invested in engagement building activities digitally. They've relied on engagement to be primarily in person. Meanwhile, transactions have long since migrated to digital. And there lies part of the problem. So with that backdrop, I'd like to advocate elements of an entirely different customer experience paradigm. And I'm going to talk about it in words first with this slide, and then it'll be in pictures on the second. I hope the combination will be clear. So we think banks need to operate and orchestrate an increasingly complex system of engagement, and I'll define system of engagement versus engagement mechanisms in a moment, in ways that support a broad range of use cases along the entire shop, buy, use continuum, not just sales and marketing, but developing and nurturing relationships flexibly along the entire customer lifecycle that transcend all points of engagement and can do so on customers' terms whenever and wherever they choose, delivered through a combination of human-centered design, highly nuanced, context-sensitive personalization, and rigorous staff training. Why rigorous staff training? Because engagement mechanisms do include face-to-face interactions or in-person interactions with contact center and frontline branch employees. Those are still massively important. And these need to include both proactive as well as reactive approaches that can vary dynamically and individually based on customer data. That flexibly access and share data across channels, core banking systems, as well as increasingly far-reaching external ecosystems using APIs, and increasingly doing so in real time. And then lastly, using mechanisms that continually learn and change using a portfolio of learning systems that have been institutionalized in the organization so that it creates greater utilization, which in turn accelerates learning, creating a virtuous cycle. And I'll show some specific examples how this has been institutionalized in my bank examples later. Here's the same thing in pictures. In the center, I'm showing the entire customer life cycle, from shopping to the buying experience to the lengthy using customer journey. In many banks, marketing operated and still does operates independently from channel operations. Typically, marketing owns the public web presence, and they're run with marketing automation systems with campaigns, and they generate leads and that are then taken action by lines of business. So marketing looked after the shut part of the continuum, and the delivery channel teams owned the buy for origination and the use, in other words, onboarding, servicing, all those parts of the customer cycle. And the customer experience in this old paradigm was often not assessed nor managed throughout the entire journey, and that needs to change. When it comes to delivering the experience, we observe a few aspects of delivery excellence among banks that we think distinguish themselves. Those are human-centered design, relevant personalization, and rigorous training. Human-centered design is often employed in the design and operation of personalized and proactive engagement models because it entails building deep end-user empathy, which then can discern consumer intent. The approach involves generating many ideas and building multiple prototypes along with iterative or continual testing. Those are inherently difficult and a very different way of doing things than many banks have enjoyed over the years. These same banks demonstrate skillful use of engagement mechanisms. As those mechanisms proliferate, institutions need to be adept at offering and tailoring them individually to clients across a wide range of use cases, because not every customer seeks, for example, conversational chat-based interactions with their bank's mobile app. Those that do might prefer to use it narrowly, such as for short questions. Other mechanisms may be preferred, for example, if a card is lost and so on. And so no one mechanism is a silver bullet, so banks unfortunately have to be adept at a growing number of them and integrate customer experiences and their journeys across them. There's lots of talk about machine learning these days, and we think machine learning is quickly becoming the backbone of modern learning systems, but it's not the only approach, and it can be used alongside other methods. No single approach can optimize customer experience with a growing complexity of engagement mechanisms and their high rate of change. Other approaches like A/B testing, randomized control trials, and direct customer feedback need to all be used and orchestrated. And lastly, using both proactive and reactive approaches are increasingly important. We're here for you is a reassuring sentiment, right? But it's entirely reactive, but that's how most banks operate today. They build branches and place them in convenient locations and offer convenient operating hours, and they wait patiently in their lobbies for customers to come in, and then they react spontaneously to customer needs and reactions. But when banks operate reactively, customers have to perceive a need and take the initiative to engage a banker with that need. The realm of lobby choreography, for example, is aimed squarely at optimizing the in-branch reactive customer experience. And that's a worthy discipline, but institutions now must excel at both reactive and proactive approaches to customer engagement. So now that we've talked about this somewhat theoretically, I'd like to cite a few examples. Now, each of these 6 examples happen to be Celent Model Bank winners in 2018 or 2019. Celent Model Bank is a global initiative Celent has been doing now for 11 years, seeking to find and reward innovative uses of technology in banking, but not just for innovation's sake, but innovative applications of technology that actually advance customer and business outcomes. And I don't offer these 6 examples up as being equivalent. Indeed, they're not, and I'm going to contrast them in 2 different ways in a moment. I'd like to talk very briefly about the first 4 and then camp out just a little bit in more detail on the last 2. Bank of America, with its Erica Insights, has garnered lots of press lately and indeed has no small number of users, 20 million or so, if my recollection serves. And Erica used to be, a bit trendy as a virtual assistant, but she was quite reactive initially. But in relatively short periods of time, with expanded capabilities, the bank's virtual assistant is now supporting a growing number of use cases and is becoming highly proactive. And that's increasing customer utilization and customer value. Commonwealth Bank in Australia has an example of a customer, what he calls customer engagement engine, and it's simply an enterprise-wide next best action analytics mechanism. And while there are many banks that operate next best action analytics, that's difficult for me to say correctly, there are two ways that distinguish Commonwealth Bank from many other implementations. First, its implementation isn't merely in the digital self-service realm. It is increasingly offering this engine to customers directly via self-service, but also through staff members in the branch and in the contact center. In fact, the initiative started by empowering branch employees with next best actions. But the other distinguishing factor lies in the bank's strategic intent. The bank's intent with implementing its customer engagement engine, which was a large initiative, an expensive one, by the way, the strategic intent was not to build sales, although it had that end result. The intent was to improve the financial lives of their customers. And here's one simple example of how they do that. A meaningful percentage of the bank's customers consistently were late payers, for either card or lending balances. And like most banks, Commonwealth Bank levied late fees for those occasions. But using the customer engagement engine, they targeted those customers proactively, inviting to remind them when payment was due, and even afterwards, within a grace period, offering to waive the late fee for customers who would act quickly. You might say, why would the bank do that? They were investing in initiatives that would erode the bank's near-term non-interest income revenue. And indeed, that's exactly what happened. But that modest loss in short-term revenue paid off handsomely in terms of increased customer satisfaction, loyalty, and net promoter score. Although not explicitly measured, we think it went a long way to improve the trust levels among their customers. Because after behaving in ways like that, customers knew the bank had their back. And not every bank customer, from our surveys anyway, would say that. Finovate offers a very broad access to financial services across an ecosystem of third-party providers linked via APIs. What they call Finovate Smart Market is a digital marketplace offering their community members access to much more than traditional banking products. Moneyline, we think, is an example of industry-leading, comprehensive personal financial experience that is highly individualized, personalized, and proactive. And RBC and Umpqua I'm going to talk to with a few additional slides before handing off. I mentioned that these initiatives were not equal, and indeed they're not at all. This slide compares them along two dimensions. First is the points of engagement supported. And by points of engagement, I mean the physical devices or locations. A branch would be a point of engagement, an ATM, a digital device. But the engagement mechanisms are much more diverse. There can be a variety of ways, for example, to engage a customer on a mobile device. SMS, chat bot, right? Live chat, video chat, social media, and the like. What we can see by this slide is most of these initiatives are starting in the mobile realm, with the exemption of Commonwealth Bank, which started in the branch and then has expanded omni-channel-wise. But over time, we see many of these initiatives expanding both in terms of the number of engagement mechanisms they support, as well as the points of engagement across which they're offered. Another way to look at it is shown here, and this compares the various approaches to customer engagement in terms of being inherently reactive on the vertical side to more proactive higher in the chart. RBC and Commonwealth, for example, are highly proactive. Bank of America began reactive and is becoming more proactive, and Umpqua Bank is following the same pattern. And then on the horizontal axis is the ecosystem reach. Most of these examples in the current environment comprise the realm of traditional banking products. However, initiatives like Moneyline and Finovate invite a broad ecosystem of non-financial products into their value proposition. And we think that there are two examples, forward-thinking examples of where many in the industry will head. Now a few words about Umpqua. For those of you who know Umpqua Bank, they're a relatively small Portland, Oregon-based community financial institution that has now grown to be many tens of billions in assets. Umpqua established its reputation as a longtime innovator in the branch or in-person environment. And seeing the same channel transaction migration trends shown on the right as many banks, right? Explosive growth in digital and erosion in branch traffic. Several years ago, they sought out to establish how the bank could maintain its relevancy in an environment where customer engagement was increasingly digital. And it did so with a long-term initiative that started back in 2015. In an unusual move, the bank launched a holding company called Pivotus Ventures, basically an innovation hub located in Silicon Valley, staffed by non-bankers for the most part, and operated very independently from the bank. Their role was to figure out how Umpqua Bank could be relevant in an increasingly digital-directed world. They first did concept testing using a variety of digital engagement mechanisms that then led to pilot testing of more successful endeavors, which then led to significant staff training and an expanded pilot which encompassed several dozen branches and 2 different contact centers. What they then eventually rolled out nationwide in 2018, the bank calls GoTo. There's a variety of aspects to that initiative, but said simply, individual customers of Umpqua Bank, all customers by the way, are offered a free digital personal banker regardless of account balance. Moreover, it's a personal banker that's not assigned, but a personal banker, a go-to banker that each individual customer chooses. And what's fascinating is when you talk to Umpqua Bank about how customers choose their personal banker, they are rarely chosen based on their financial services competency. Because probably like a doctor you might choose, or a surgeon if you need a surgical operation, you're likely to assume that they're competent. You might choose them on an entirely non-medical basis, and so it is with Umpqua. They might choose a personal banker because of where he or she lives, what he or she likes to do, what her hobbies are, or even if they just like dogs. I, by the way, chose a surgeon in no small measure because he and I both enjoy cycling, and I could relate to the guy. And yes, he did a good job, but I knew he would. That's not why I chose him. The second example I'd like to cite in more detail is from RBC, Royal Bank of Canada. Do you remember Personal Financial Management, or PFM? Many thought it was a great idea, but not too many customers did. Not too many of them used it. And as a result, not too many of them found it very useful or valuable. And in part that's not because PFM was a bad idea, it was how it was implemented. It was typically manual, cumbersome, overwhelming to customers. They had to figure it out, and it was buried within the mobile app or the online banking experience. But what if the same data could be informed by state-of-the-art customer experiences that customers come to enjoy from non-banks? What if it could be seamless, engaging, enjoyable, ubiquitous, easy, satisfying, worthwhile? If PFM could be delivered that way, in ways that were automatic, intuitive, relevant, and therefore highly useful to customers, they would be used in significantly greater extent and represent much more value to the customer. And that's indeed what our Royal Bank of Canada did with its NoMe. NoMe Insights is one of 2 closely related products that the bank seamlessly integrated into their mobile banking app. NoMe Insights is based on a pre-built AI application from an outfit called Personetics. It's built right into user-specific work streams. And in real time, it offers predictive and actionable insights and advice personalized for each user and tailor to each user based on real-time user feedback, thumbs up and thumbs down interactions, much like you do on Spotify or Pandora. As a result, the apps learn transaction by transaction and user by user. Things like meaningful events or unusual activity are highlighted, and are changes in spending patterns. NoMe Find and Save is a sister product that offers personalized and automated transfers from available funds into savings account in the background automatically for customers, removing friction, kind of like the Digit app, if you're familiar with Digit, except it's not a separate app. It's baked into the digital experience for each and every RBC user. It creates a low-friction experience compared to having to download and set up a new app and link it to your existing accounts. It's very easy, very intuitive, very relevant, highly used, and valuable to RBC's customers. So in summary, this new customer experience paradigm is increasingly digital. Engagement is moving from in-person only to a blended in-person plus digital mechanism, and banks need to equip for that. And along the way, as you do, remember that transactions and engagement are two very different things. This new customer experience is also proactive. We're here to help you is important but no longer adequate. Value delivery is not about selling products, but about improving the lives of customers. And sometimes it involves a product, sometimes it does not. And then this new customer experience paradigm is rapidly changing. And since there's no single blueprint, but there are some common elements, and we've highlighted a few of them for you. And so as the pace of change continues to accelerate, get used to it, but also equip yourself to keep pace with it. And that's all I have. Now I yield the floor to Andrew.
Thanks, Bob. Some fantastic insights there. Really appreciate that, so thank you. And if you've got any questions for Bob or for me, for that matter, just pop them in the questions box on the screen. We'll make sure we try and keep a couple of minutes at the end to see what we can do to answer them. So what am I going to talk about today? Well, what I want to do is take Bob's advice and then really break it down into something you can start immediately. Practical next steps, really, in getting you moving down that road to being your customer's first port of call when it comes to anything financial. And that's not easy. You're going to be laden down with those legacy systems, those complex decision-making structures that make it really difficult to execute on even simple things. And there's that nasty little fact that Bob added at the end of his recap. There is no single blueprint that you can easily follow. But he did mention there are themes and groups that we can use to give us a clue. So I'm going to use Quadient's own digital maturity scale to help us group those next steps. And here it is. And as you can see, it's focused on communication. And that's not just because we're the world leaders in communication at Quadient. It's because, well, let's face it, if you're going to increase the trust that your customers feel in you and your organization, you're going to need to communicate with them and let them communicate with you. Bob talked about being proactive, and that means getting your message out there. Now, this part of the webinar, I should say, isn't directly about how you can digitally transform using our scale, so I'm not going to talk through the information on the matrix in minute detail. If you're interested in that, we'd love to help you, so just stick a comment in the questions box. We'll get in touch with you and explain it in more detail. But today, I'm going to use it within the context of improving trust only. So we'll start by taking a look at maturity level 1 and seeing how you can improve trust if you're at that level. Level 1, the most basic level of digital maturity when it comes to the way that you communicate. But just because it's so basic and so much money's been thrown at digital transformation over the last few years, sadly it doesn't mean that it's a rare sight in the banking world today. Across the world, we see financial institutions of all shapes and sizes that have added digital capabilities but never considered transforming the way that they communicate with their customers alongside it. To an extent, it goes back to Bob's slide almost at the beginning where he talked about product versus experience. Banks at this level of maturity have added product functionality, but haven't seriously started to think about how the experience should look. If you're unsure about whether you're at this level of maturity or not, the word cloud there on the left is aimed at helping you. You're likely to refer to communications as correspondence or even letters, because you'll be using systems that were originally defined when letters were the only way of realistically communicating with your customer base. If you want to talk to someone about your communication strategy for your company, you're probably going to struggle to find someone you can talk to, outside maybe of marketing for the glossy sales documents at least. If you can think of someone, they're probably going to be in IT. We often see organizations say they're at a high level of digital maturity until we ask them to look at it this way. Because when you link your digital transformation to the way that you communicate, it opens up a whole new lens on the situation. The reality behind a level 1 digital maturity is there's no direct control around the strategy, the transformation, or the technology of communications. It's been left alone for a long time, and it's starting to show its age. Your ability to react to change, it's almost non-existent. And so your ability to get messages to your customers quickly, very difficult as well. So how does that affect the trust that your customers have in you? Well, let's spin it around to look at things from the customer's perspective. I bank with an organization that has a digital maturity around about this level. I tend to start to sigh despairingly before I've even ripped open an envelope. And then I'll either do one of two things. I'll either glance at the content and immediately put it in the pile for shredding, because there's nothing of value in that communication. Or I'll glance at the content, I'll frown, and I'll make a note to call someone later to tell me what they actually meant to say, because the generic legalese makes absolutely no sense. And I don't have time to read through 10 pages of terms and conditions to try and find out what's actually relevant. Ultimately, the way that a digital maturity level 1 bank communicates creates frustration and confusion. If you think back to Bob's part of the session, how on earth would I expect to think that I would ever receive competent advice from an organization that can't even send me a communication that makes sense and at the time that I want to receive it? Now, if you're one of the many organizations that's in this situation, there's a long way to go to get the customers to trust you, so much that you've closed that trust gap that Bob talked about entirely. But there's plenty you can do to start that process. For a start, your organization is crying out for someone to own the problem. It's going to be painful to solve it, but doing nothing for so long isn't actually going to cause you as much pain as you may think. Because organizations that have been ahead of you on this journey, they've made mistakes. They've gone down dead ends in trying to improve their communications. So you can learn from them, and you can speed your journey onwards a bit. We'll cover those when we talk about the later stages of maturity. But for this level, be that owner. Think big. Be the person that says it's just not good enough and that you could do so much better. And in the short term, think small as well as big. You've a long way to go in fixing your entire communications infrastructure. But you can implement improvements to key areas really quite quickly. How about taking a look at your ability to communicate with customers in an emergency as an example? If you're at level 1, your inability to react to problems can cause problems for customers. If you've got a problem with your credit card gateway as an example, I don't want to find out about it when I can't pay for my meal, because the best that you could do was send me a letter a week later. What I needed was a rapid communication, perhaps fired as an SMS or a smartphone push notification to my mobile app, telling me proactively that there is a problem and that you're really sorry, but you don't want me to try and use my card because it's going to be declined. It doesn't necessarily solve my problem in every case, but there's a chance that I could stop by an ATM before I go to the restaurant or something like that. And it certainly feels like you know me. You've sent me a proactive message warning me that something may happen and averted an awkward situation. An emergency comm system like that is just one small example of a point solution that you can implement reasonably quickly and cheaply to start to build customers' trust in you while you work on those much larger foundations of your communication strategy. So if you're at level 1, think big and think small. Let's move onwards and upwards to level 2 though now. If you're at level 2, it's likely that you've got several methods of communicating with your customers. Some of them will be digital, but they're all probably built on different technologies and managed by different teams. They're also likely to be used mostly for high volume batch communications, not the sort of on-demand, real-time communications that customers sort of expect to see today. And regardless of the number of channels you've got, paper's still going to be the vast majority of your output. And you're likely to have a lot of manually generated paper communications, probably Microsoft Word-based, that sort of thing, hidden around in various departments. The focus for communications in a level 2 organization, generally cost control. Just like Bob said when he was talking about the transactions versus engagement piece, ostensibly, you've identified that customers don't really want paper, they want digital communications a lot of the time. But the reality is what you've really identified was that print and postage is very expensive and you need to reduce the costs. And now you're looking to migrate as many communications as possible on a like-for-like basis to PDF or to email. The problem is that many of those communications are generic. They aim to cover as much of the customer base as possible without going into detail or being clear or concise, because they're based off the old communications you had at level 1. And that's the hub of the problem when it comes to customer trust at this level. We'd all love our customers to buy our marketing spin all the time, but the reality is that customers are really quite clever, and they see you trying to use their money for your own profit without delivering any value to them. I've lost count of the number of times I've seen emails from banks imploring customers to switch off their paper statements to save the trees. It's a noble aim, and I'm all for environmental responsibility, but what's actually in it for the customer? What have you done to improve their relationship with you, on top of just reducing your own costs? Customers are starting to see through that sort of marketing. So why would I trust an organization that's putting their own concerns above mine? Now, there's 3 practical steps we could take if you're at this level. First one is a change in thinking. Start to think like a customer and think about what would be valuable to them, not you. You'll soon realize that what you really want the customer to really want isn't really what the customer really wants. You want to save money, they want value from you. It's not what your execs really want to hear, but it's the truth, and it'll help you if you get that right now when it comes to the later stages. In terms of projects to begin, use that new thinking and take a look at your highest volume communications and ask yourself what value it adds to the customer. Is the communication generic? When you actually have more information you could use to personalize that communication or cut out those generic parts? What are you proactively telling the customer that will help to show that you're using expertise with money to help them? This is your chance to talk about those areas that Bob touched on, about next best actions on affordability, on sound financial management, and also using that automated intelligence that you have or you'll be building to predict that future financial position for the customer and warn them if necessary. It doesn't make you any money, but a customer will trust you so much more if they start to see that in their communications. And then start to build out that omni-channel foundation by gathering the customer's preferences across all your channels and storing them in one place. Consistency will always gain trust. So you don't want to be sending customers an SMS, say, for one type of communication and then paper for another, just because that system didn't have somewhere to set an SMS preference. Customers will start to expect the best from you based off what you have available. So don't have small pockets that can't accomplish that. So at level 2, stop thinking about cost saves. Start thinking about what value you can add to that customer. You're the experts. Start to tell them about it. You'll find that it still saves you money because your failure demand will drop considerably once you start telling the customers what they want to know in a way that they can understand it. So you'll get your cost saves, just using them as one of many metrics, not as the sole target. If we move up to level 3, we start to see less problems now and more opportunities. If you're at level 3, then you're likely to still be paper first, but you'll have pretty much all the channels available to you, and you have a coherent set of those customer preferences that we were talking about that you can use to make sure you're consistently communicating on the right channel. You'll have your content all sorted into one location, and your audits probably all solved as a result. So that all sounds great. Why isn't it level 4? Or maybe even level 5? Well, it's all down to the value that you're adding again. You're at the multi-channel stage. The ability to run entire processes through a single channel. But the communications have generally been left behind. The process has been carefully thought through, but the communications are still the same or very similar to the ones that were sent out when you were at those lower levels of digital maturity. If they are digital, they're still likely to be PDFs, so those paper versions. You're taking the single most valuable opportunity to add trust by adding intelligence and value to the journey that the customer's on, and wasting it by sending basic data that doesn't really add anything. And even more importantly, because your solutions are built in channel-focused silos, you're losing the ability for the customer to switch between those channels and engage with you in a different way. If they do that, they're likely to find out that their bank isn't quite as joined up as you'd like them to believe, with the need to maybe repeat a whole host of data entry tasks and things like that. But like I said, a few quick changes at this point can make massive improvements. If you're at level 3, you've still got too much paper, but your preferences are all set to change that now. So continue to look at those high volume communications that you're still sending via paper and get them moved across to digital, and add all of that value that I talked about at level 2, at stage 2 as well. Now is also the time to think about your operational and your technological systems. A single cross-functional operational team is ideal if you're trying to run your communications. And the fewer technologies you've got, the easier that is to do. So start to look at how you can consolidate your communication solutions onto a single technology so you can get that same consistent, proactive message out to your customers across all those channels. And finally, start to think beyond those channel-specific solutions. That gets you to multi-channel, but it won't get you to the point where you can give the customer the best experience. If you can separate the process from the channel, you'll get to that next stage, which is omni-channel. So at level 3, you're at that turning point. Your basic problems have been solved. Your customers can at least trust that they're going to get something from you that's accurate. It hits the right tone. It can potentially be delivered in a channel that isn't paper. But it's time to really kick on, to lay the foundations for the next phase, getting it so your customers really start to value what you do and the way that you do it. And that's what starts to happen when you hit maturity level 4. Here we've got all of level 3, but we've also got that cross-functional communications hub. So we're managing the content, the deployment, the publication, the message across all your organization. Excuse me a second. Not sure what happened there. There we go. It's all together in that one area. You're going to be digital first as well. Every communication will have multiple formats that aren't paper, but you will still have paper just in case you've got those customers that aren't digital. And all those communications will be available in both that old-fashioned batch mode and in real time, so they hit that customer as soon as they need the information. If you're in that position, well, firstly, well done. At Quadient, we see the very best full-service banks across the world just starting to get to this position when it comes to the way they communicate. And the reflection from the customers in terms of their trust starts to be really positive. You're enabling banking in a manner that's started to be designed around them, not around your systems or your back-end teams and your processes. Your customers can understand and they can trust the message they're getting from you, and they see the value to them. For next steps, well, you've digitized your communications, and that's great. Now it's time to digitally transform them. Communication doesn't have to be something that has an address at the top and a signature at the bottom. It can be so much more. If you've got that world-class comms technology underpinning your capabilities, you can create communications in the same way that you can create web pages now. And that means you can add so much more value. So how about making everything responsive? Having the ability not just to proactively explain a situation to a customer, but giving them the option from that communication to click straight through to somewhere that lets them take you up on that advice, all from one button press. All of a sudden, you're turning a communication into the start of a conversation. You're offering direct and obvious value to the customer. You're really clear that you know the customer you're communicating with, you've analyzed their situation, and here's both your assessment and your recommended next steps. You're not waiting for the customer to come to you, you're making it easy for them. It's a million miles from what we talked about back at stage 1, and it all implies that you genuinely care about that customer, that they can trust that you've got their best interests at heart. And the upside of all of that is you're making it easy for customers to experience the best of your product suite without the need to check other banks and shop around. Who said that customer experience can't yield a profit, eh? And finally, we get to that highest level. There are very few organizations outside the neobank world that can claim to be here when it comes to customer communications. But to show you what we're aiming for, there's no such thing as a communications team anymore. The communications and the digital teams have realized they're both doing exactly the same thing, just with different channels. So they've merged using one technology platform for everything. You're applying all of those same processes as well to your long neglected staff channels. And your costs are now so low that all your internal conversations are about adding value, improving experience, working in the customer's best interests. They're not about reducing the outgoings column on the ledger book. At this point, your customers are becoming followers. Every communication is read as quickly as it can be because the customer knows you're trying to help them in some way. And they trust that you're doing the right thing based on all the information that you have about them. They also know that you're making things as easy as possible for them. And your cross-sell and your upsell ratios should be going up as a result. So where do you go when you're already at that amazing level? Well, it's time to start acting like a neobank and change that paradigm a little. As an example, I've got an account with a major international bank. I have internet banking access and their mobile app. I log into one of those channels once a week at least to check my accounts. I also have accounts with 6 neobanks. Every one of them offers me a checking account, and I've got a savings account with some of them as well. They only offer me a mobile application, and I never log into them. Which of my accounts do I know the most about? The traditional bank that I access all the time, or the digital challenger banks that I never access? Well, oddly enough, it's the neobanks. I log into my traditional account because I have to find out what's happening, really. And that leads to metrics set by traditional banks about how successful their proposition is. The more people that log in, the better it must be. The neobanks have started to think a little bit differently. They push every bit of information to me the moment that it happens. Every transaction that takes place on any of those accounts causes my phone to buzz within seconds of the transaction happening. So I know what's going on, but I don't need to log in. So if you're a level 5 bank, start to think differently about when and why you should communicate. Communications don't have to be for a big event. Micro communications through a smartphone push, an SMS, they don't cost much, but the value that they can deliver to your customers is enormous in knowing everything that's happening in their account the moment that it happens. And just because it's tiny doesn't mean you can't link it up with your next best actions, your financial suggestions, like you're now doing with your other channels. Constant communication like that, you start to create a level of trust that's creating an almost cult-like following of these neobanks. I know it may be hard to imagine, given where we've been this last decade or so, but it really is possible for customers to love a bank again. So there we have it. Simple steps to increase trust in your organization based on how you communicate with them, to help you close that trust gap that Bob talked about towards the top of the hour. And the best news, if you're now thoroughly infused to get cracking and improve your trust through revamping those communications and experience, doesn't matter which level of digital maturity you're at. At Quadient, we can help. That's just part of our integrated award-winning product suite on screen for you now. Banks across the world have used our software to truly transform everything from traditional communications through to their internal form processes, even their onboarding. If you want to talk more about any of that, we'd love to talk to you too. Check out our website at quadient.com. Ask for us to contact you. We'll be in touch straight away to help you to change the way that your customers think about you for the better. And with that, I'll say thank you for listening to me. Thank you so much to Bob for the fantastic insights into trust. And I'll hand you back over to David to see if we've got any time for questions for Bob or me. Thank you.
Thank you very much, Andrew, and thank you as well, Bob. We certainly do have a bit of time for questions. I want to first thank you both for an incredibly rich presentation and discussion on a number of issues that I think sometimes seem a little bit in the abstract, but then hearing you both elucidate them and provide some of the context and examples becomes so clear, the challenge between transactional versus the advisory trust that banks have and the motives that banks have to do the sorts of things that they do, and how that can get in the way of them making the sort of changes and transformations that they need to make. Just really, really fascinating stuff. Again, we do have about 5 minutes left, so let's turn. We do have a few questions here that I think might help maybe shine even a brighter light on some of the things that you both brought up. I just wanted to bring up this one in particular. It had to do with, since we were talking so much about specific examples, and this one I guess maybe goes toward you, Bob, that there were 6 examples of banks that had invested in improving their customer experience. And this question sort of focused explicitly on the idea of closing that trust gap. And would you say that those examples in each of those cases that you could sort of say that an explicit closing of that gap occurred?
Yeah, great question. Obviously, a straight person in the audience. So we think they did. The thing is, many banks don't measure advisory trust as a standard KPI, right? So they'll measure things like net promoter or satisfaction, and app utilization, or in the case of NoMe, verifiable savings levels and how they changed over time, right? So lots of favorable indicators, but in none of those cases do I know explicitly that advisory trust grew. But we think by a multitude of other indications that we could be confidently affirmative in that answer.
Mm-hmm, mm-hmm. One thing also I thought was interesting was the idea of communication, and both you, Bob, and Andrew touched on this idea of how to communicate, not to only communicate when it's an emergency type of thing where you almost might end up dreading hearing from your bank as opposed to looking forward to it. And one of the questions that came across was the idea of adding trust and financial institutions really being able to differentiate if you've got some of the so-called tech fin companies like Apple and Google doing the sort of things with their micro-communications. How is it going to be possible for some of these FIs to sort of compete with those folks?
Yeah, perhaps I'll step in on that one. I'd say that people like the tech fin companies, the Apples, the Googles of the world, and the other open banking players that are really stepping in there, they're doing half the job, but that's because they've only got half the data. They tell you what you've just done, and that's a great start. But when it comes to adding trust, they don't have the rest of the financial data to make any judgments and to offer you anything more proactive. As a bank, you do. So let's say Apple can make my phone buzz, like I mentioned, to say that I just spent $10 on coffee. But my bank could tell me that I've just spent $10 on coffee, which means I've got $990 left in my account. And based off my spending patterns, that means, maybe that's my direct debits, my standing orders, that sort of stuff. It's likely that I've got $500 left come Friday night. That way, I'm not just presenting the customer with information, I'm offering my advice as a responsible financial institution. I'm adding value. And if I'm doing that, I'm pretty sure that customers will come to trust those judgments.
Excellent, excellent. We've got about 2 minutes left, and then there's one question that came in. I think it's relevant to what you both said, and also to the point that Bob made with regard to metrics. And maybe I'll sort of combine this with, I think, another question which might sort of sum things up for you both. The first question is the idea of what KPIs would you recommend that folks could use to recommend or to measure trust, given that's a bit of an elusive concept. And maybe sort of as a side to that, how do you get the buy-in from the people who need to commit to making these sort of changes? Maybe briefly from each of you on either of those.
Sure, I'll go first. So in Celent's case, right, we were doing two different surveys of consumers. So we need to ask explicitly about trust, right, or satisfaction or other things. But there are implicit ways. So like one of the ways three of the different banks proceed is by offering ongoing feedback mechanisms. Was this helpful? Was that helpful? Did you like this? Did you not like that? And you can infer trust by utilization. If things are not helpful, then it will be very apparent digitally to the bank. So implicit trust is one thing. Another thing is just asking frequent, not like in formal surveys, but frequently just by way of pop-ups, right? Would you like more of this? Yes or no, right? Those kinds of things can can be very helpful in understanding our customers engaged, because without engagement, it's uncertain if they trust the relationship.
And perhaps I step in just very quickly there and talk about I think they mentioned the question about getting the buy-in. Just very quickly before we wrap up, I would use the customer's journey to do that. So don't map things out in terms of features and functions. Map out the full customer journey. You'll start to see what the customer's experience really looks like. And that'll let you visualize those areas where you can add those further value and be proactive. But it'll also show you the areas that are touched. So where you're going to need the buy-in, and where the experience just gets so bad that you're definitely going to need the change. When you're in an environment which is so customer-centric, or the desire is to be so customer-centric at the moment, it takes a very brave executive to look at a customer journey that shows a really bad experience and say that they don't care about it. So if you can visualize that, it's always a great opportunity.
Excellent, excellent. Well, thank you both very much for your thoughts and your insights there. That's all the time we have for today, I'm afraid. Thanks again to our hosts. Thank you for joining us. Please know that we will have a copy of the presentation available on the Finovate blog shortly in the coming days for you to go ahead and review the presentation for today. Thanks again. We'll see you next time. Bye-bye.